Deutsche Bank stock has lost more than a quarter of its value in just this month alone. This follows the ongoing banking crisis that has jumped across the Atlantic. What originally started with Silicon Valley Bank, then a couple other regional banks that had lost most of their value because they were effectively insolvent. They had made loans at low interest rates. Interest rates went higher as Jerome Powell tried to squish inflation. And now you're seeing this crisis in confidence spread across the Atlantic to Switzerland. You see UBS buying Credit Suisse in a bid to halt the banking crisis. This is effectively a shotgun marriage, buying Credit Suisse, nearly wiping out their equity value. And then you see it jumping from Switzerland now to Germany. Looking at Deutsche Bank bonds jumping, in terms of the cost of insuring Deutsche Bank's debt. So the cost of saying, hey, your debt will not default within the next few years, these credit default swaps, the costs have jumped higher. So this does reflect broader contagion fears. And this does reflect that investors are worried about the system. They're worried about the institution. They're worried about Deutsche Bank. We'll talk about Deutsche Bank's balance sheet in just a second. And when you see this cost of CDS going higher, it does make it trickier and harder for a bank to do business. And this is what you saw immediately before Credit Suisse was effectively forced into this shotgun marriage with UBS, where UBS is acquiring them, where if the CDS jumps higher, that means your counterparties are going to say, well, wait a second, it's going to cost effectively even more money to make sure that I can trust you, that you're going to be good with your end of the deal for whatever agreement we reach. And so as that CDS, that cost, the credit default swaps move higher, that does create the risk that their access to other counterparties shrinks, and it does impact their ability to, let's say, issue new credit. So you could start seeing this spill over into the economy, potentially in the very immediate term in Germany. And given what we've seen so far, it wouldn't surprise me if we see a global credit crunch as these banks face this contagion fear and challenge. And so this is what's going on with Deutsche Bank, but it's not an overnight crisis for Deutsche Bank. It's been, look, over the last 20 years, Deutsche Bank stock is down 70%. This is not what you want to see. And it's partly due to, weak results, weak management, some of which, skirting the law, where you see German regulators saying they were unhappy with their money laundering controls, Department of Justice from the US finding them several, over $100 million related to corrupt payments and bribes. So this is not only weak operations, but weak ethical and moral controls, which might be funny, hearing from a banking sector. But that's, you need to follow the rules. Otherwise, you're going to be fined. And you look at their results, they have improved significantly. In 2022, they generated around €5 billion after tax profitability spread across several different divisions. This is not just, a simple bank like a Silicon Valley Bank. This is a bank, a huge global bank that has corporate operations, investment banking operations, private banking operations, and asset management. So this is much bigger and spread out across several more divisions. So that is important to consider. And you might say, well, wait a second, with €5 billion in profitability, nearly 7 billion before any sort of provisions, why are they even facing problems? Because their profitability clearly is improved. Well, what's happening to Deutsche Bank? First of all, in full disclosure, this is not financial advice. And if you're looking to take charge of your investment journey, consider unrivaledinvesting.com for compelling investment ideas, real-time portfolio updates, and our exclusive Discord server available for annual subscribers. And so as I look at Deutsche Bank, this is what's always critical to understand whenever you look at any bank. You want to size up their balance sheet. And so this is always the first step for me when I look at it. You go, what's the assets? What's the equity? And when you look at the total assets to the total equity, you think, well, how much can assets go down until your equity get wiped out? And that's why I did a previous video on Silicon Valley Bank. And I said, look, it looks like they're pretty much insolvent. I don't see how they recover based on that super quick acid test. And literally within 24 hours, they were seized. So when I look at what's going on with Deutsche Bank, it's a lot harder to get a clear picture because you're looking at a bank. First of all, it's much bigger. This is one of these huge, too big to fail type banks, 1.3 trillion euros. In terms of assets versus 72 billion euros in equity. I don't like the slim cushion there. That means that if you only have a 5% drop in their total assets, your equity gets wiped out. That makes this way too hard for me. But if you wanted to understand this in greater detail, you would need to dive into effectively a few of their key categories, which is their loans and their total financial assets, of which, this total financial assets, which is not nearly 500 billion euros in value, nearly 300 billion of which, so the majority of which, it comes from derivative financial instruments. So that, turns into another question, which is, as your CDS costs go up, will it be harder for you to maintain a derivative portfolio? Because you have counterparties saying, well, wait a second, I don't necessarily trust doing business with you. Overall, I think the key takeaway, as you want to think about what's going on with Deutsche Bank, what's going on in the world, with this ongoing banking crisis, is number one, I think what Steve Eisman said, and he was profiled in Too Big to Fail and The Big Short. He was played as Steve Carell in The Big Short. And so Steve Eisman, he recently talked about this crisis. Look, it's very different than what you had with the Great Financial Crisis, because there you were doing with effectively bad credits, where you're looking at subprime loans. Here, it's about, central bankers not necessarily being available for you because they're fighting inflation, and also some bets that haven't worked out because interest rates have moved higher. That's very different than, levering up on bad credit where you're not going to get repaid at all. His main takeaway, and I really love this point, was you don't want to be a hero. Don't be a hero in this environment. And that's, I called out to my subscribers at unrivaledinvesting.com 2 ideas this past week. We're looking for things that are much easier. One is a company like a 5% dividend yield growing 40%. Another company, that I recently been buying is a company trading below liquidation value that I think has 100 to 160% upside. So that is the type of thing where I don't have to be here. I don't have to say, okay, here's a 1.3 trillion euro balance sheet. Do I know the ins and outs of it? And I'd argue you don't. It's really, really hard to fully understand a bank balance sheet. And Warren Buffett has made this point repeatedly, that banking analysis is very hard. Usually when I look at banks, it's either too hard or obviously insolvent. That's like the vast majority of cases. In this case with Deutsche Bank, it's the too hard pile for me. First Republic, Silicon Valley Bank, I go, that's, closer to the obvious insolvency, or they're effectively impaired. You occasionally get a bank where you go, wow, the numbers jump off the page, but it's much easier to analyze. You're not talking about a $1 trillion bank or 1.3 trillion euro bank in the case of Deutsche Bank. And so looking at this is just too hard, but you do have this legitimate risk of contagion as investors effectively look to pull capital, or counterparties say, hey, we don't want to do business. And this is reflected with the credit default swaps jumping higher, and that could have an impact on their business. So the question is, well, at one point, does it cross over where it really starts impacting their business? And no one really knows exactly how far it goes. But what you've historically had, at least for the past, let's say 40, 50 years, is you have interventions from the central bankers where they'll say, okay, well, we see there's a problem going on. We're going to step in to make sure it's all right. We're going to step in to make sure this problem is smoothed over. And you saw that with Credit Suisse, where they say, okay, well, let's just do a shotgun marriage. UBS will help you, buy Credit Suisse, and you can pay a cheap price. Here with Deutsche Bank, once again, dealing with one of these mega banks, it's unclear how far the central bankers can jump in. Will the ECB be willing to jump in, provide credit, invest directly in the balance sheet? Well, that's a very tough argument to imagine some sort of intervention, because just earlier this week, the European Central Bank said, no, our top priority is fighting inflation. We're going to raise interest rates another 0.5%. So this is the challenge, and this is part of the crisis in confidence that you're seeing right now, which is that you do not have, and I've said this to my subscribers at Unrivaled Investing for some time, you do not have the central bank at your back the way you've had for decades. This is a whole new game, and this is part of the fear and contagion. We need to see how everything settles out. I like Steve Eisman's comment. You can't be a hero in this environment. And the prospect of intervention is a lot lower, because the central banks are saying, wait a second, our number one battle is making sure inflation's under control. And so this is really problematic, especially when you're looking at the fact that technology has changed. When you look at the, it's a wonderful life, the bank deposits, people are lining up, it takes time. Now you have mobile deposits. Silicon Valley Bank had $40 billion try to leave effectively in a day. It's very easy to pull their capital. So if you have that sort of situation, could you see faster bank runs? And the regulators have said they've never seen, Jerome Powell earlier this week said he'd never seen a bank run at that speed before. So this is part of the reason why you're seeing contagion. And part of the reason why it's a problem is that psychology plays a key role with banks. If you have a cookie company or a candy company, thing is See's Candy, Warren Buffett, if you have a crisis in confidence, that doesn't really impact how much, candy you're going to sell. People are going to say, "Oh my goodness, I'm worried about the economy. I'm worried that See's Candy is going to have enough money at the end of the year." Well, if you want the chocolate, you're still showing up to buy the chocolate. Whereas if you're at Deutsche Bank, and your counterparty starts saying, "Hey, we don't trust doing business with you," that directly impacts your ability to do new business. And so you have this sort of self-fulfilling problems. So we'll see what's going on. For me, this is way too hard. The balance sheet, just too big, too hard to spot if there's a hole there. And so I'm looking at this. I don't want to be a hero. I'm looking for the 1-foot hurdles, not the 10-foot hurdles. We'll see how this plays out. I think at some point, in order to stop the banking crisis, you're going to need to see some sort of intervention from the central bankers where they're going to say, "Hey, we're going to accept higher inflation." We'll see what happens, though. We'll see how that plays out. If this video has been helpful for you, you've been watching Unrivaled Investing. Thanks so much for tuning in.